All right, we'll go ahead and get started, and I'm sure we'll have a few folks coming in here just after the hour, but let's go ahead and jump into it, everybody. Thank you for everyone joining us today. This is our monthly investment webinar. We've been trying to do these each month this year in 2025. Really, the focus of these is to not just educate and provide more insight about investments, all things, but a lot of things maybe that relate to investments, like some of the planning strategies, such as the last webinar Sarah managed or facilitated on taxes with a CPA. But our goal today really is to be consistent, educate all things investments, but also give you more of a kind of a preview, I think, into how we do things when it comes to managing risk, and maybe even ways we capture investment opportunities as a result. And again, this isn't to suggest that you need to learn everything the way we know it for you and how we're doing it, but it's really designed to give you some more confidence and conviction in what we're doing, just so you can sleep better at night and have peace of mind, because there is a lot of noise out there, especially right now in the current events related topics. So today's discussion, as you will see, is really around how do we manage some of that risk? How do we manage some of that headline risk and capture the investment opportunity? My name is Marc Jimenez. I'm a senior wealth advisor here with CAM, also the chief investment officer. My wonderful colleague, Sarah Contino, who you see also, she is a senior wealth advisor also and a member of our investment committee. She's based in Tampa. I'm calling you today from Austin, Texas. So we are a few hours apart, but obviously interconnected in many ways when helping clients. So today, kind of just jump into it here. Give me 1 second. There's our disclosures for the compliance folks to make them happy. I'll put it up for a hot second just so I can check that box, as we always do. Most of the people I see on this webinar, I know pretty well or have met, but some are new. So definitely some background here in the firm. We do a lot of things for clients. For those of you who maybe are new to the firm or don't know, not just for families and busy executives and business owners, but even some specialty things that we do down below you can see when it comes to planning, investments, and other areas of expertise. But just some background. So what's our agenda for today? Our goal today is really to cover about 35 minutes of the entire session. We'll get through our parts pretty quickly and leave time for Q&A at the end. Of course, if anybody has any Q&A or things that come to mind as we're going through it, please submit them in the chat. And at the end, we will look to cover those areas, those topics, and answer the questions for you. We'll definitely want to dive into a few areas that we think are very important, as we talked about on the webinar invitation, and cover some things that might be very related to not just how we're doing things, but also how it's very relevant to what we've been seeing in the markets and how we've been managing that. Sarah and I, we were discussing this earlier this morning. Her and I actually have worked together. Many of you might know this, for almost, Sarah, if I'm getting my numbers wrong, I think it's almost 25 years since we first met and started working together. Both in Austin and in Denver on a couple different opportunities together. So we've been through some periods of volatility. I know some of the ones that resonate with us were in our early days, in such as the .com era, 9/11, at times when maybe markets were shut down for several days in a row, which people may not remember, such as post 9/11, or even periods of like the .com when you saw U.S. markets down for a couple of years in a row, which people may forget that can happen at times, which is not abnormal, but has happened before. So we have some thoughts and some stories we can share, and we'll try to maybe insert those today. So jumping into our agenda, using a rules-based process to manage headline risk. While investors might want to keep stocks or keep invested in a lot of stocks, not just while they're working, but even through retirement, and thinking about different ways to invest and which might be better for you. So let's kind of jump into that. But I want to cover just briefly this notion of headline risk. So for those of you who may not be familiar with that term, it's a term that's thrown around in a lot of circles, not just in our world, but in the media, maybe at a cocktail party. You've heard this. It's something that we manage a couple of different ways. We view headline risk as something that is somewhat noisy, in our opinion, but can have a material impact in some of the day-to-day things that we might consider for our clients. In this example you see on the screen here, it's the chart of just taking a global equity index, right? An index that tracks all global stocks around the world. And as you can see, in 2024, which is what this period is looking at, it was positive, right? Almost 17% for the year. Some people may only know about the S&P 500, which did better than this, but global stocks did pretty good as a whole last year. Why I point this out is because, as you can see, it's not a straight line, right? It had some bumps along the way. Back in April, again down in August, and every month or two, it had bumps because of uncertainty around geopolitical, global conflicts, inflation numbers, right? CPI numbers were all over the board. Concerns about, economy slowing. You had an unprecedented presidential candidate drop out of the race, right? You had the election happen. You had expectations or uncertainty around what was going to happen. So all these events that happened throughout the year, the market was able to climb that wall of worry, as we call for it. And it was very easy for many of us to listen maybe to the news, the media concerns, beliefs we have, to maybe take those headlines and want to sell stocks, want to sit out of the market, want to wait it out, or maybe make a decision at the wrong possible time. And those investors that stayed the course, rebalanced, managed risk accordingly, they were rewarded for having that discipline. And that's pretty important because, as we saw last year, as we just highlighted, the global stock market across the board was up, especially in the US. But if we look at 2025, it's a different tune. This is a little bit of a noisy chart, but I'll highlight what I did here. So basically, this is taking some data from our friends at Bloomberg and I did a half dozen market indices, market indexes, and just blindly and randomly took them to see what the performance has been year to date. As of a couple of days ago, the quarterly data isn't available. I took large cap stocks. We took small cap stocks in the US. We took internationally developed stocks, emerging market stocks. We took corporate bonds, and we took treasury bills. Unlike 2024, when the US market was doing very well, this is actually the international markets. A lot of people, if you talked about buying international stocks, at a cocktail party, they would have probably maybe laughed a little at you and said, yeah, that's pretty good. They did pretty good last year, but not as good as other areas like the S&P or maybe some of the Magnificent Seven, as you heard about. But overall, year to date, 9–10% about what the international markets are doing right now. Emerging markets. Had you brought this up at a cocktail party and said, I want to buy emerging markets in my portfolio, you might have been thrown out because they were terrible last year relative to everything else. And in some cases, very much negative. You have these little areas right here, corporate bonds and treasuries, positive year to date, not real sexy or exciting, but compared to these other two areas, doing a lot better. And these other areas, the white line is the US stocks, the S&P 500, large cap stocks, and you have the small cap stocks. So again, a little bit of a reversal in 2025. Again, we're not here to say what's going to happen the rest of the year. We're just saying, had you listened to some of the headlines, listen to some of the recommendations out there that exist, you may have made bad decisions. And so our goal is trying to understand or trying to utilize rules and processes to help avoid and kind of tune this noise out for the benefit of our clients. So what does that look like? Right? One of the questions we get from clients is, how does CAM rebalance? In short, we rebalance essentially every day, right? We essentially rebalance every day. And some of you may be thinking, well, how does that happen? That doesn't sound right, Mark. And there's really two forms that takes. So I'll start with the role of our investment managers. Our investment managers that we utilize, that manage, ETFs or mutual funds that we might invest in for you in your accounts, they have to have certain criteria and characteristics, also be like-minded in terms of our philosophy and share some common denominators. But their role is to constantly rebalance and keep the portfolio, each fund that they're managing, right, inside of your accounts, to target, right, balance to the goal of that strategy. For example, if we're hiring someone or investing in a small cap US manager or ETF for your benefit in your account, we want that manager to only deliver US small cap exposure. We don't want them venturing out, drifting out and buying bonds, holding too much cash, buying international stocks. They have a goal that they're hired for, and that's what we want them to do only. And we also, by working with larger managers that are experiencing positive cash flows into their funds, they can rebalance every day. So that's really good for investors because there's a lot of funds out there that are not experiencing positive cash flows and money is leaving. And we do stay away from those for a lot of reasons. But for the benefit of our clients, these managers, because they're getting cash every day, they're keeping the portfolio rebalanced every single day in a very efficient way. That's good for you. Our role, right? What's our role here in rebalancing? We take a little bit of a different view. We don't rebalance every day, but we do have technology that helps us manage a few things for our clients. One of them is just we do weekly cash invests. So whenever somebody has too much cash in their portfolio than they should, we go and invest it essentially almost every single week, right? It doesn't happen to every client every week, but it happens enough. So it's one of the things we want to keep cash tight because cash can be a drag if you're not investing it the right way. We also will look at soft monthly rebalances where we might rebalance a portfolio if it falls out of balance, as we call it. But we try not to trade too much for different reasons. And then if we haven't potentially rebalanced the cash invest or the soft rebalance on a quarterly basis, we will look to rebalance a client portfolio back to target if they need it. So there's a process. Again, we control it. It's not automated, right? There's not a computer just pushing the buttons. We still control it for many reasons, which we'll discuss in a minute. Target model portfolios. Again, these are just targets, hence the word. We're not trying to just put everybody in the same portfolio. The target is really just there as it sounds. Our portfolios that our clients create aren't just developed on risk and return. It's based on what our clients need, right? It starts with the plan. So anything we do on the investment side starts with the plan, and we develop what's called an IPS or an investment policy statement. And that's signed off by you, as many of you know, before we ever push any button to trade, make changes, or rebalance. That drives the ship. And of course, every client's going to have a customized situation along the way. We do some more custom strategies when it comes to rebalancing, as I list below. Some hedging of concentrated stock. If somebody works at a large company with $1 million in stock or more, we might want to try to hedge that and protect it and rebalance it gradually. We do more advanced tax reduction strategies for those needing to offset gains. We can do some harvesting and other interesting things to reduce your tax bill and save you thousands of dollars every year like we do. And even look at retirement income strategies, which Sarah will cover a little bit here in a few minutes for our clients. Rules-based. What does this mean? So the rules-based rebalancing process is something that we really take a lot of ownership in, making sure we do correctly and accurately and proactively. When it comes to trading and implementation, we have what's called tolerance bands. These are basically just a range to the upside or downside that allows us to look at the portfolio on those rebalance states and suggest, okay, if markets, if something gets too heavy, like last year into January, the US stock market was doing really well. So a lot of US stocks were getting way above balance. We look to rebalance and trim those profits and rebalance to other areas of the portfolio that needed it. Same thing happens in the last few weeks. Those US markets got really low in some cases. We rebalanced other parts of the portfolio to bring those back up to target. Those are real-time events that we just did and have been doing continuously the last several months. One thing I'll touch on briefly is momentum. This is something that you engineers, mathematicians, and quants out there might appreciate. I'm not going to get into how we do this because it's beyond the scope of this discussion, but momentum is something that we look at not to time markets, but we look at it to help our clients not just maybe make a little bit more money over time, but save you money. For example, there's evidence, and we use this academic framework, when there's a sharp movement in stocks to the upside, momentum might suggest that that upward movement might continue for a little longer. So we might wait to rebalance and take profits a little bit longer. To the downside, stocks can also go pretty sharply downward. We might wait to rebalance and buy stocks at lower prices until some of that calms down. Very complicated, but yet very disciplined on how we do that. And we also don't just trade to trade, even though ETFs are free nowadays. There's still minimum trade size we employ to control costs and the bid-ask spread. And that carries over into tax aware. Everything we do is tax advantaged or tax aware for our clients. The asset location on where to buy an IRA, Roth, taxable account, all those things are part of that. And the last thing I'll comment here before I get into the next discussion is patient and flexible approach. Our managers, you mentioned headline risk. When something's happening in some of these global conflicts, global events, pandemic, when markets maybe aren't tradable, we can step back and wait, right? You're going to be already well diversified. So if we wait a day or two or a couple of weeks before we reinvest cash or rebalance, it's not going to hurt anybody. Our managers do the same thing. So really, really important, something that not everybody does, including some of the traditional index managers out there. So something to cover there, which is really important. I wanted to cover a couple more slides before I hand it off to Sarah. So the 60-40 problem, the 60-40 problem that people say is a problem, I don't know if it's a real problem, but it's something that people need to think about maybe a little differently. You know, the problem that some people might say, well, the rule of thumb is broken, 60% stocks and 40% bonds no longer is applicable. It might be just fine for a lot of clients. Why this may not be applicable, some have said, is because that 40% bonds, maybe interest rates are lower and you're not getting as much from the bond part. 60% stocks, maybe you need other cute investments to do more for you, right? There's a lot of arguments out there for different reasons. We're not going to cover that today. What we are going to cover is some history here in the 60-40. The 60-40 was born from a couple of academic laureates here from 1952 and into the 60s. Markowitz and Sharp, if you went to undergraduate finance or business school, you know these guys too. The 60-40 rule of thumb came from these guys. Keep in mind though, when these were developed, this framework, the market was much different. The S&P 500 or large company stocks was the biggest universe to buy stocks in the public markets. There was bonds and treasuries, but there wasn't that much else out there. Today, the market has changed. The S&P is about 5 or 6% of the universe. More importantly, something else has changed since 1952. Who can quickly tell me in the chat, you know, what was the life expectancy for those in the US born in 1952? And don't use ChatGPT or Google to find out. All right, I'll tell you. It was just shy of 67 years old, right? 67. Why is that important, right? Well, I'd argue that most people I know born in this year, 1952, have already outlived that, right? So I think that's something to think about. Fast forward to 2025, somebody born in the US, what is their life expectancy on average? Or at least what they say, depending on the source. I'll tell you, it's just shy of 80. Again, I'd argue that that's too short. Most people born today and this year are probably going to outlive that number. Why am I telling you this? I'm telling you this because when 1952 or the 60-40 was developed, the retirement or the expectancy of someone's life through retirement needed to last maybe 10 or 15 years after they retired. Nowadays, it's very easy for someone when they retire, it has to last for 30 years or more in retirement. So there's a reason why you might have to be more aggressive than a 60-40. And likewise, getting too conservative too fast or when markets get jittery can compromise your ability to meet those goals in the future. So to wrap up here before I hand it off to Sarah, understanding why we should all invest in stocks is important. Life expectancy, retirement looks different, longevity, and other reasons to hedge long-term inflation. So with that being said, I'm going to hand it to Sarah to talk about how to maybe balance some of these risks and develop income for the future. Sarah, take it away.
Thanks, Mark. So today I'm going to walk you all through how we think about investment strategies for our clients and how we help move from just growing wealth to using it with purpose, especially as they approach or enter retirement. So there's more than one way to invest, obviously, as you've seen in what we've been talking about. These are some popular investment strategies. You may have heard of some of these names. If we throw some out there like growth, moderate, conservative, total return, capital preservation, a lot of times people don't know exactly what they mean, but the main difference in each of these is the level of stock exposure and the type that drives risk and return expectations. So the key to picking a strategy is knowing what to expect from your portfolio and what you need so you can pick the correct strategy for you, regardless of what we end up calling it. So if we move on to the next slide, we can look at how we would maybe select your portfolio. So the way we manage risk is to control the dials and how much exposure is essentially in stocks versus more income-based items. So portfolios like the speculative that we saw earlier are on the far end of the risk scale where equity is over there to the right. Growth and total return might be in the middle with some growth in income exposure. And then conservative capital preservation, they're going to be toward the left with most like fixed exposure. So these are, think about CDs, bonds, things that we know are going to guarantee a fixed rate of return. So when we are aligning what is considered, a good fit for clients, we're working together with you to determine what your comfort level for risk is. And we know because of evidence-based investing, other things that Mark's talked about earlier, what a typical swing will look like from the high expected return to the lows. based on that composition that you have from one of these portfolios. So not only are we looking at what your comfort level is with the market, but also some other factors like how much growth do you actually need to have in order to achieve your target goals? Too much risk, which is over there on the right-hand side, may not be necessary, but too little risk. So if we go all the way down on that scale to the left can also be problematic. For example, the far end of this chart with equities will be stock market risk, which, everybody of course is focused on right now during times like this. And if the variability of returns feels like it's too much, if we can also achieve your goals by having less risk, then we'll likely step down on the scale toward that more conservative. But going to the other end of that spectrum, then back to fixed income, of course, there's risk there too. And it might feel comfortable to know, for example, that we can get, say 5% return on a CD, which is great, right? No loss of income. We're making a small return. In many cases like that, it's guaranteed where we have no loss of principal. But the risk not often seen here is, are we able to stay ahead of inflation? When that CD comes due, number one, will rates give us a similar rate of return at that time? And then number two, we could be underperforming our purchasing power and not really realizing that until it's too late. So regardless of whatever we call the portfolio, ultimately, we just need to match your risk comfort level with what you need as far as goal success and outcome. So if we want to move on to the next slide, we can kind of talk about once we're in retirement, the concept of like where my paycheck will come from. I know this is a kind of a scary concept for a lot of folks that are heading off into that retirement, or maybe even if you are in retirement and you're concerned about your portfolio because of the variability in the market. Again, with this being a top question that we typically hear from people, what I've tried to do with a lot of folks is consider breaking up your expense need into two different buckets. So number one, essential expenses. This could be, your housing, utilities, food, insurance, healthcare, basically what we absolutely need for basic living expenses. And then the second bucket is non-essential expenses. So travel, hobbies, gifts, any other lifestyle upgrades. So our goal is to cover essential expenses with guaranteed or reliable sources. That could be things like Social Security, pensions, different secure investments so that our clients don't have to stress about those basics. So that's going to be at the base of this pyramid that we're showing here, which is this stable spending. So after that's covered, we can move to variable spending or non-essential spending. And it still can be generated from your investments, just depending on how we have them invested. So maybe more income is being generated and poured over into some cash or something short-term. So you can still take that annual trip or participate in your hobbies, but not be as concerned about that fluctuation that's happening in the market with the rest of your portfolio. And then, beyond that, hopefully we have the opportunity to also look at some legacy spending. So if we've planned for your income needs, addressed healthcare, long-term care, any other items like that, we can start to address legacy. So whether that's your family or some type of charitable inclination, you could start to position your investments towards these strategies as well. Ultimately, we believe a successful retirement income strategy must include a balance of security and growth so that your income can keep up with rising costs over time. So let's take a look at that in the in the next slide. So let's just say your essential income need as a household is $100,000. And you already are, or you will be receiving income in retirement of $65,000. Now let's just say that could be from Social Security, pensions, or some other fixed sources. So your gap for your essential income might be $35,000 a year in income. In the past, this is probably where we've seen a lot of investors get caught up in those annuity traps because they feel comfortable with that security of annuities. But what often is not seen are the incredibly high costs, inflexibility, and then long lockup periods. Conversely, if we were to take all the money and move it into fixed investments like we discussed earlier with CDs, that can also create a problem with long-term returns, purchasing power, inflation, et cetera. So our solution to that would be a CAM income strategy, which can be guaranteed or like a variable income. And this is designed to create fixed income without annuities' typical downsides that I talked about, like no insurance company fees, no long lockup periods, and more transparency and flexibility. So by carving out a portion of the portfolio to generate income, we give clients the freedom to invest the rest for growth. So knowing their basic needs are covered, we've got CAM income strategy plus a growth bucket, and that equals a sustainable long-term strategy. So in this example, I just put one item down here of if we need an additional $35,000 a year in income. One solution here would be a guaranteed income stream. So if we need the 35,000, that would translate in this case to about 307,000 invested. That could be guaranteed for 10 years. And then we would put the rest of the funds in more of a longer term or a growth bucket. Again, we still would have maybe some variable spending where the income or dividends would peel off and somebody could still add to some additional income. But we've essentially left alone the rest of the funds to be able to grow and to not be concerned. I mean, essentially, we don't have to worry about tapping into that bucket of funds at all for another 10 years. So, that allows for a lot more growth, more stability. I know a lot of folks that I work with also feel more comforted in knowing that could be a really great solution for them. So, what Marc talked about with respect to investment management and how we rebalance portfolios, and then along with the examples or some of the things I'm talking about with income generation for retirement, just kind of shows how we structure portfolios. But really our main focus here is always primarily for clients to feel secure today so they can be confident in the future. So with that, I will close this out. And I know Marc and I want to open this for some Q&A if we have a few minutes left. Hopefully can address, I think we had a couple of questions come in already. But if not, feel free to enter a question into the chat.
Let me adjust this. Give me 1 second here. All right. I know we had some. I'm gonna start, and again, thanks, Sarah. Put your questions in the Q&A. I'm gonna read off of these. Some we had received before. First question is, do you use any algorithms for determining what funds and how much money to rebalance? As I mentioned on that one part earlier, we do have a system that helps us manage and be alerted when somebody is out of balance. We have models that we do have with different funds, and typically the rebalancing system will tell us about how much we should take from each and move them around. But that's where we still have to apply some human element because of taxes and other things that are real and custom situations. So we do have systems and technology that follow a process that rules-based. It's not this automated, Wizard of Oz type of machine behind the curtain doing that. So there's an element there, but good question. One question is, and Sarah, this is probably a good one for you to answer, I think. At what point should I shift most of my money to fixed income or CDs?
Yeah, getting a lot of that lately, which I would say I don't ever think it's really a great idea to move 100% over. So when we're talking about our strategy for investments, we don't want to time the market. That's something we know we can't do, but there's definitely ways that we can structure so that we can create safety still for clients. But the risk is so great of just going 100% to cash or 100% to CDs, even though some of those rates, and they've come down recently, but even at one point, around this time last year where we were seeing some of the highest rates for CDs and high yield money markets, we're still battling inflation. So when we look at like those real rates of return, we have to really be considerate of what's that going to look like for a long period of time. And then the next question, that you and I have had for many years too, is when do we get back into the market? If that's something, if we don't want to necessarily sit on the sidelines or be in CDs forever, when would be that right time? And as you and I know, that market timing doesn't work out for folks long term. So I think the concerns about the market or being afraid of it, we definitely can come up with some solutions for that. We just have to be strategic with how we do it.
Yeah, good thoughts there. And I did hear a stat when I was in New York a couple weeks back, sitting with a group and one of the largest insurance providers in the country, that in the last 5 years, annuity sales have doubled. Which again, I'm not saying that they're not a fit potential for some people out there, but I'd argue that we tend to see situations that maybe it wasn't ideal. So the good news is that there's innovation and we have new solutions nowadays that can replace the need for that in most cases. Another question, do you use optimizers to construct your model portfolios for clients? Good question. So for those of you who may not know what an optimizer is, it's basically something that looks in the rearview mirror. This is kind of a short way of saying that. And optimizer, the purpose of it is to look at what's happened in markets. Its purpose is to look at what's happened in markets and then come up with an allocation that someone should invest in going forward. And those, as you know, if done the right way, we'll call it, might be okay, but typically what it's looking at, it looks at the most recent 3 years of performance for different parts of the capital markets. And naturally, if it's going to take the best performing asset classes over the last 3 years, your portfolio is going to own a lot more in those areas. And so if we take the last 3 years of what's happened at the end, as of the end of this past year, we can pretty much, without even thinking about it, say we're going to have a lot of large cap stocks, a lot of tech stocks, not very much in bonds, not very much in some international stocks. And this year would not be a great experience thus far had you made a lot of changes looking in the rearview mirror. So optimizers, and there's a lot of people out there that use them to come up with asset allocation models. They may not tell you that, but we see it. I learned about this back in my former life, that there's ways to, there's flaws basically in optimizers. So we don't use them. We have a multi-factor model. I will say that we do apply as to construct portfolios, and then implementation is based on your needs, right? Not what's happened in the past. So good question. Sarah, I know this is a little bit what you talked on, but how, and I'm going to give it to you, how and when do you reduce risk as market volatility increases?
Well, I think that's tricky. I don't, to reduce market volatility while the market is going down. We're kind of selling. We've sold low and then we're buying high again. So I would say typically when I'm working with my clients, I am assessing risk up front to say, let's walk through, if these scenarios happen, what you can expect and the variability of returns. So probably holding tight is really the true answer to like, what do we do about risk? And then the rebalancing. So like in this case, we've had some volatility. We've seen different markets go down. This is a great time to rebalance, and making sure that if we're not at those optimal levels for, market stock exposures, that we want to be able to then move back in, which is kind of counterintuitive because we're basically saying we have to be brave enough to put money into the thing that's going down, but that actually is exactly what we need if that structure and that investment policy or asset allocation that we decided upon is truly in fact what you still need. That allocation should work for you in any kind of market, up or down.
Good answer. And kind of related to that, there's a question, and you touched a little bit on this in your slides. Are there, if somebody is going to own some safe investments, what should they maybe be during periods of market volatility, right? Obviously, assuming they're doing it the right way.
So I think, first, what would that money be used for? So if it's something short term and we know that money is going to be allocated for a purchase, we certainly want to keep with CDs, cash, something that's giving us the highest yield with the most amount of, preserving that capital. And then I think we also have to assess, when is too much cash? When is your cash too much, right? Because now we're starting to go back into that trap of, sure, we've preserved this money, we have a decent yield return, but we also may be leaving some growth on the table if we're, especially we're not keeping up with inflation. So I think each individual is going to determine what, as we work together to do a plan, how much we need to have in those conservative assets that are easily accessible. And even within the portfolio, we usually have some of that too.
No, that's good. That's good. Yeah, I know we're coming up on time here, so there's a couple questions that were kind of related, so I'm gonna paraphrase these. It's related to what we titled the presentation. How is CAM taking advantage of market volatility for clients' investments? Basically, there's a few ways we do that. We're rebalancing, as I mentioned, within our rules-based process, right? We're not automatically, just because something's down, do we buy more of it. We look at momentum. We're also not automatically looking to or quickly fill up these buckets or allocate across the portfolio. We're very mindful of volatility, headline risk, interest rates, and all these things. But we are systematically rebalanced, and we do it very quickly, typically because right now, and especially over the last several months, you've seen U.S. markets not just down, but U.S. markets in some of these tiny, very tiny companies that are also down, for example. This is just one area that we've been adding to. Some of these are off 30, 40%. Now, we're not going to go out and buy individual stocks typically in this area because most stocks don't make money over time. Not everyone knows that, or they don't make very much. And we buy the broader market through ETFs or mutual funds. But we're also seeing this area present opportunities because the US markets, or just large companies in general around the world, have done very well, right? They've done very well, well above their average. So we have moved and bought in to these other areas of the market at much cheaper prices at the expense of selling at high levels. So that's one thing we're doing already. People have asked about what are we doing in response to tariffs. I'm not going to get into tariffs because there's a lot of debate about what they are or aren't. I will say this, that tariffs as of 2018 were at the lowest level based on imports we've ever seen. It was like less than 2% on imports. We're almost 3% now, and it looks like we're not going to ever get down to that low level. That was kind of unusual. What does that mean for investors? It doesn't mean anything really, in my opinion, on the stock market. I think it means more in the bond market. The bond market, what that will do is it will adjust rates on the longer end, typically, which is why you're seeing short-term rates still come down with the Fed, saying they're going to lower rates, and you're seeing intermediate yield or intermediate bonds, the yield on them going up, right? So we're very mindful of that. And because of that, we're also rebalancing. We're staying short in terms of credit and treasuries on the duration or maturities. But we're also owning things that are floating rate. Many of you know what I'm talking about in terms of alternative fixed income, alternative lending, private credit. Those are floating rate. Those benefit from those floating rate or those higher long-term rates. So we are doing things out of rebalancing to put clients in position. We don't know when these are going to happen, but we want our clients to be in their seat when they do happen, so you get paid. But we do like buying the cheap stocks at the expense of the more expensive and selling them. And we do like taking advantage of the yield curve or the interest rate environment as a result of these other policies playing out. So with that being said, we should probably wrap up and let everybody head off and resume their lunch or whatever they're doing today. But I want to say thank you. I'm sure over the next few months, we'll have more to talk about in our next monthly updates. So thanks for attending. For those of you who didn't, you'll get a recording of this. And for those of you who did, also get a recording. And if any question wasn't answered, we'll follow up with you as well. But again, thanks again, and we'll talk to you soon.
Thank you.
Thanks, guys. Bye.